Hey, everybody, good afternoon, and welcome to the 2024 bear market. This is Doc Severson. I've got Dave Lukas with me here at 12 Minute Trading. Today's Monday, the 5th of August, and wow, it's been an amazing couple of weeks. I mean, if you consider all the stuff that we've seen, we saw the Trump bump, a couple of weeks ago with everybody thinking that, okay, the election's over. And then that changed 2 days later or 5 days later, something like that. And now, what's amazing is we just had a Fed meeting and everybody's begging them to come back together again and like get it right this time. So it's funny because I've seen this before, and this reminds me so much of the 2007, exactly the same things for the same reasons, August in 2007. So Dave, what are you seeing out there, man?
I was actually going through the analog of all that for our mastermind meeting this evening of how that all unfolded in 2008, because it didn't happen like it just fell off the cliff. There were
Right.
so many like traps and everything before it really fell over, and that's why like people are asking me, "Are we going? Is this it? Is this the bear market?" Bear markets usually don't start like this. This is a correction. This is emotional trading. Yes, this really has to do with Japan. A lot of people are saying it's recession fears. Nah, that's not in there yet. This is all Japan. And you said what happened the last couple of weeks? It's the last 3 days. It's the last 3 days that most of this selling has happened. And it all started with Japan raising interest rates and blowing up the carry trade. So for those of you guys that don't know what that is, for 30 years, Japan has kept interest rates at zero. And so what all these hedge funds and all these big players have been doing is they've been borrowing effectively. They've been borrowing or getting bonds at nothing, right? From in yen cheap from Japan, then turn around and buying effectively like bonds in the US with like 4%, 2%, 3%, and arbitraging it, and then also leveraging that to buy stocks. And so Nvidia, all these big players, what has been fueling them for the last couple of years is just people taking that money that they've been making from the Japan arbitrage, carry trade effectively, and then investing it in stocks. And because it was 0% interest and everything else. But what Japan did, the Bank of Japan, and they may have to pivot pretty quick. What they did is they raised interest rates, and what that did is it strengthened the yen. Like overnight, the yen went up like 6% against the dollar. So what happened was now you got all these people that basically borrowed on this stuff that are getting margin calls because their yen is worth a lot more of the dollar. So that arbitrage isn't there anymore. And they're having to sell their stocks and everything else to then turn around and pay all these back and pay these bonds back and do all the stuff they've been doing. It is a massive, massive leverage crunch. And it's just you're seeing basically like a short squeeze, out of it.
And
just the opposite way.
What a lot of people don't understand is that when there is a ripple in the system like this, because this is what it does, it causes this cascading effect. And all of a sudden you're getting margin calls. And when you receive a margin call, basically that's the broker saying, hey, stop what you're doing right now. Either you sell something or we're going to sell something for you. But you have to come up with this much cash right now. And so you're going to go in there and just boom, hit the bid on just about everything that you've got that you don't care about. They may be perfectly good investments. During situations like this, even gold gets thrown out the window. Even supposedly safe harbor assets get thrown out the window because people need liquidity and they need to raise cash right now.
That's why Bitcoin's down 10,000, because some big player was arbitraging that thing and was using that money, using that borrowed 0% interest borrowed money, to basically buy Bitcoin, and they got margin called. And so, there's been a lot of chatter about that. And so like the thing is like, it'll be over when it's over. I don't know if it's over yet. I think we're close to it being over. like anything, like you see in a short squeeze or something, you shake it out and everybody gets wrinkled out, and then you find your bottom and you go. We may be close to that today. We'll see how today ends. If we end at the lows of the day, we're probably not there. But if we hold in the areas we've been for most of the day or rebound some into close, we may be finding a bottom. And based on the charts, we probably are really close. We are very far outside the Bollinger Bands on the daily chart. Usually you snap back in, even if it's short lived, right? Because back to the 2008 thing, you would have these like seemingly like massive down days, and then you get the spike back up, and then it plods one, then you get the next one, and so on. And it's like that for a while before it really falls off the cliff. So are we there yet for a bear market? I don't think so. I think we have a nasty, correction we're having to deal with, 10, 15%. But went to cash mostly ahead of this. It never fails. I was going on vacation, so I tried to clear as much as I could. And of course, I go on vacation and markets fall apart, right? But that's kind of where we're at. So yeah, you can show them on the charts where things are.
Now there's a couple of really cool indicators that I've used in the past for times like this. So if you guys know me, I spend most of like 99% of my time just looking at the price, because I've just over time just like gotten rid of stuff off my charts that I just don't need. One of them that I will watch, and this does work out pretty well, is looking for the RSI 14 to go underneath 30. And as of this morning, I think it was like 28. So the RSI 14, when we were down here at the lows of the day, this was below 30. And that's been a pretty consistent, if you look at this, let's scrunch this up and look at some of these previous signals that we've seen. But you can see this when we're below, and this is the upper study here. Look at this line here. When the dip in that indicator gets down near 30, which is like last October in 2023. That was a great example of that. In April, we got right down near 30, and then here we are again. Now, there's no guarantee this is going to work out the same way, but this generates evidence that we stick up in a pile. We're looking for confluence. The study that's below here is the McClellan oscillator. This is a real old school stock trader study that's been around for 800 years, right? And what we're looking for is something around a negative 300, about a negative 300. So if we're looking at dips down here like this, these are all very, very close to negative 300, if not below that. Now, of course, you're gonna go back to something like the pandemic, when we had the pandemic, and that, of course, is going to be like, blows everything out. That was negative 400 for that one. But a negative 300, right now we're negative 195, and that's off of the lows of the day. So we're very, very close on some other studies that are sort of, I guess not that many people watch. And then if we look at the fractals themselves, now I am back to a 9 period because markets are much faster when we correct. I'm back to a 9 period. But if we look at this on the ES here, we are right back to the 200-day moving average. That's a good sign. We are near exhaustion on the daily chart for the swing down. That's a good sign. Okay, the weekly chart is now starting to pick up. It was peaking in energy just a week ago. It's now starting to pick up on this move down. It's not at exhaustion at all. And look at what's happening with the monthly chart. The monthly chart's saying, thank you very much. About time I'm getting a break. It's like it's been huffing and puffing up the hill for the longest time now without a break, and it really seriously got into exhaustion here. And so if you think about it, guys, this is exactly what the market wants right now. It wants a break. It wants to chuck off all of the Johnny-come-latelys that bought back in, July and things like that. When we were like backing away from the market, I mean, go back and listen to some of our earlier live streams that we did. We got back in June and July. We're like, warning, danger, Will Robinson. This is a very top heavy market because we had the Mag 7 driving things, and then one by one, the Mag 7 was falling off.
Right.
One by one. So, I mean, this all makes sense in past. It doesn't make it any easier to trade for you if you're going through a correction for the first time. And by the way, guys, if you got questions out there, please fire away, while you got us online. For those of you that are live, if you're watching this through a replay, which is most of you, if you want to just email us for our next time, so next Monday. And also, don't forget this Wednesday.
This is also actually very healthy to keep a bull going. I know that sounds really, really weird right now, but having we've been talking, I think we've said it on here many times. It's very rare. Like it was weird that we haven't corrected 10% this year and had a good correction like that. Now, should it happen within 2 to 3 days? No, but it's certainly healthy to keep a bull market going. And you and I were just talking about, like, the VIX is the third highest level, like, that we've seen, fourth. Yeah. Like, you had 2008, you had COVID, and like we're right up there again on the VIX. Like, that doesn't last typically too. That's another kind of sign that, hey, okay, the VIX has gotten to a level where it's got to basically retrace, right? Which means we're probably getting ready to get, and I'll tell you what, you get out of these, you get a face ripping rally. Most of the time, it doesn't get, to like new highs. It'll fail and then roll over again is what you have to be ready for. But like starting tomorrow, we could start seeing a face ripping rally come out of this thing that just is relentless. So you got to be prepared for that, because that's what happens from these extreme fear levels and stuff like this. Is you get this nasty, nasty kind of, just rip out of it. And then it gets everybody on board and then fades them all back down to the downside again. So that's something you have to really, really be conscious of. And we're close to that. Those are the big things. Who knows what else though, right? There is still talk of Iran and Israel going at it in the Middle East. So we have some wild card events that still can affect things right now. But if barring all of that stuff, we're probably close to the end of this and getting ready to have at least a relief bounce. So
we're just for those of you market historians that are out there, the worst ever VIX spike was back here on Black Monday, and this is 1987. And I had no idea what the hell was going on back then. I just joined my first real company and was just a working stiff back then. But number two was the great financial crisis back in 2008. So Dave is correct here, because all of this fun started in 2007. And if we have time here, I'm going to walk you through
go ahead.
What we went through in 2007. But that's number two, is a great financial crisis. And that the worst selling is always at the end of one of these things. And then, of course, we had number three was the pandemic. And then we're at number four right now. Number four, imagine that, who'd have thunk it? But notice that we're well off of the highs from today. Off the highs from today. So, Dave, go ahead and talk, because this is going to take me a minute to find this thing.
Yeah.
I got to go back.
So, and again, like the times to trade feel the worst. Like the other thing Doc and I were just talking about, we were talking about some trades that we're going to do in the account that we do together. And because the VIX and the volatility is up so much, the fills on options trades that we can get right now they're 2 to 3 times further out of the money than we were getting 3 weeks ago. And so this is one of those times where, you be greedy when others are fearful. And I've been sitting in cash for a while, and I'm ready to really deploy. We do futures, we sell puts on the E-mini futures, the MES, and we were just looking, and you can get fills down at 4,000 that hit our credit targets that we look for on the MES. The MES right now is at like 4,300, 4,200, right? So it's 1,000 points. Just to put that in perspective, 3 or 4 weeks ago, we were able to sell and get that target credit 300 to 400 points deep on the MES, which is still normal. That's actually what we're normally trading. So to be able to sell 1,000 points out plus, it's like Christmas. So just something to think about for you guys.
So a little bit of history here. Guess what happened back here in between the top of the market, which was in mid-July. Imagine that. It's almost like we're going through an echo of something that happened. What was that? Is that 17 years ago?
Mm-hmm.
Goodness. Okay, so the carry trade started to blow up here. The same carry trade that we're talking about today. This carry trade started to blow up. We set up to, it bounced off the 200-day moving average. Everybody said, okay, we're good to go. And then whoosh, straight down. Now, right there,
rip and rally
right there on that hammer candlestick, that particular day, that is August 16th of 2007, the Fed held an unusual emergency conference call. Yes, they did have telephones back then. Like they had a conference call with Ben Bernanke, and basically what they said is, yeah, we're going to recommend a emergency rate cut. Now, rates were fairly steady that time. Just like today, they were on a rising trajectory, and then they went steady. I forget exactly when, but it was sometime in the latter part of 06. They went steady for quite a while. And then, so all of a sudden, out of the blue, hey, we're going to cut. And then here's the specific day that we cut. And you'll notice that this is an all-time high right there. That was an all-time high for the S&P in 2007. This is in October 2007. So here we are. Here's the panic. Same deal. And notice what happened with this. Boom. Certainty provided back into the market, ground higher. Now, the biggest difference I would say between today and back then is stuff happens bigger and faster today than it used to be. There's a lot more money sloshing around in the system with a lot more leverage. So I don't think it's going to take us 2 months to do something like this. I think if there's certainty that comes back in, then it's not beyond comprehension to think that we may end up with, and let's see if I can, I'll just go back to the beginning here. It's not beyond comprehension to think that we could get a very strong rally from this point, right? So even though we're kind of getting a little bit weak here into the close, what I've seen in the past is that we'll hammer out a bottom somewhere in this area. It may take a few days until certainty comes to the market. And especially it's going to help if Jerome Powell looks like he's actually going to do something instead of talking about it. He's got to be so pissed off right now. I mean, right? Because he just did a meeting. He just did a press conference, and the market rallied the day after, right? Mm-hmm. Market rallied the day after. Everything was great. The world is great. Lower high, straight down.
Mm-hmm.
So, could we potentially hit new all-time highs? Yeah, we could. Don't be surprised if we do. But I think once we do, look out below. Look out below, guys.
I'm a little different camp. I don't think we're going to hit all-time highs, but I do think we're going to get a ripping rally that's going to happen quickly, and it's going to happen in August. That's my prediction, is that we're going to see it happen. It may actually, I don't know what we'll do this week. This rest of this week may be hammering out some things, though. We've got some earnings like SMCI's tomorrow. I think SMCI has been one of the big ones with, the semiconductor stocks and all that stuff. So if it nails earnings, that probably gives the NASDAQ, some room. I think most of the selling guys, the reason it's been in the NASDAQ is because the Magnificent Sevens, where these guys put all their money. So I think a lot of that's done. A lot of those guys have had to sell out of that stuff. So I think that's where you see the rally start and then kind of get follow on from there. The other thing, though, is I do think, and I've said this for a while, I've talked about Japan. Gosh, how long have we been talking about Japan, and the carry trade could blow things up, right? So I think that the I think we are going into a recession. The macro fundamentals are really showing it. The jobs number showed it. The ISM last week showed it. The ISM services today was pretty good. That's why you saw the market do a little rebound, right, and not stay down as low as the start. But I do think the way things are shaping up is probably Q4, Q1 of next year, we're going to be in a recessionary type environment, at least by the definition of it, if they don't change it again. And that's when I think it's going to get tougher. I think the Fed isn't going to do an emergency cut here. I think that would actually freak the markets out more than anything at this point. I just don't, after last week, what they said and where things are at and all that, I just don't see them all of a sudden meeting and doing an emergency cut, because then the market's going to go, what do they know that we don't know? And you'll get more selling and all that stuff. I think they'll wait till September. They'll probably do 50 basis points. The market will like that, right? But I think the macro is going to continue to deteriorate, and because the status quo really isn't changing on the economy as a whole, so I think that challenge is still there. People are all-time amounts on credit cards. They've used up all their savings. All that's happened, and we're going to have to deal with that. And the Fed always stays too long. In September, by then it'll have done more damage. So that's kind of where things are at. So be prepared to go into that environment. Just be prepared for a nice rally before we do. That's typically how these things start. You get like the shot over the bow, which is kind of what we're seeing now, which, Doc, I know you love to talk about the shot over the bow. And then, like what was the shot over the bow? It was like Bear Stearns, right? Back in 2008, and nothing happened until, a couple months later with Lehman and everything else. So same thing here, kind of like this is kind of the shot over the bow with Japan and everything. That financial system is breaking. It's 30 years of it doesn't work anymore. That's causing a problem. You get a rally out of it, and then something else comes in, recession, whatever it is, and then that's where things really start to get bad.
If you think about it, Dave, to your point, this actually reinforces your point. The shot over the bow for the great financial crisis actually started in February of 2007. Yeah. Literally a whole year and a half before we started to see the market started to get unstable in February of 2007. This is when it started to, and it really, really got ugly in August of 2007. This is when things really changed. So for us, this is really the first time we've been in a cyclical bull market since, you could say the bottom of the bear was in October of 22. And then we confirmed the bull back in the summer of 23. So we've been in a cyclical bull market since that point. This is really the first moment of weakness that we've seen. True first moment of weakness. Right. We had a little correction last year at this time. We had a little correction back in April. Those are all normal, but this is the first really ugly one that we've had. And many, many times these things will go off and print new highs before becoming then more unstable. So Dave and I both agree that 25 is really going to be the issue here, I think.
Any good news that comes in right now, this market rips. Anything.
So to Brewhead has got some questions on gaps. Now, these are what I'm calling upside gaps over here. These are what I'm calling upside gaps that are above the current price. These are downside gaps. So these two got closed today, and those were back from late April when we had that jobs report, which busted a move to the upside. So we had a first week jobs report. That's back when bad news was good news. And now we have bad news is bad news. Everything has changed now. Bad news is bad news. So here's some downside gaps. And I don't necessarily agree with the fact that downside gaps need to be closed. I can show you downside gaps from 2009, from 2011, from 2012, from the Ebola debacle back in 2014. I can show you downside gaps from the pandemic that have never been filled. they do not necessarily have to be filled. And with positive drift in the market, I would expect it's only during, some kind of really, really difficult move will we fill those gaps. So downside gaps no gap has to be filled. It's more than likely that upside gaps will be filled over time due to positive drift. That's really my only statement on that. So any other questions from anybody else?
I didn't take the NBA trade on this. I think there's still, I don't even know where it's at right now to take a look real quick, but I think there's still some selling to go in that, since that's been the biggest high flyer. Yeah. So what's it at, like 95-ish? So I know you sold a put the other day at 90, and I think that's probably a pretty good level on this thing. I just want to see support. I don't have to be right. I don't have to call a bottom. I don't really care about that. It's more of just show me the support, show me you're ready to turn, and then I'll take advantage. I may not hit it perfectly, but then I can take advantage. I'd rather have some of that before I just slap on a bunch of things. Unless it's like we were talking about earlier, we can hit our profit target selling 1,000 plus points out of the money from here. Like, I don't care. Let's just start selling, So yeah.
I signed off this morning with the trading room and basically said to everybody, like, hey, look, I realize these are tough conditions to trade in because nothing makes sense.
Yep.
And the one thing I wanted to leave people with is, if you are making the decision because it makes logical sense, please rethink that, because it's more than likely going to be wrong. So what works in a corrective market is to think opposite. So like the other day when we had good news from, right? So we had, weak jobs or market took off, and then everything was starting to look good. And, good earnings from, what was it, Meta and everything like that. That was the high. That was the time to short. And it just doesn't seem to make sense, right? Everything's like opposite day. And it takes a while to get your brain oriented in the right way. And what's really difficult is, like, right when you get in line with that, like I remember going through the great financial crisis, and I'm like, all right, come on, Doc, call spreads, only call spreads. Don't sell any put spreads. So right when I got in line with things is when the market took off. And so it can be difficult because nothing makes sense. Corrective markets are not linear.
Again, what feels the worst is probably the right thing.
Is the right thing to do.
So like this morning at open, guys, I went and sold 30 delta call spreads into this thing because my thought was, man, this thing can rally back up and hit these things, but I just don't think it's going to have the ability to rally back up and hit it, and so those are, at full profit. Right. And it felt terrible. Like I was like 300 points out of the money on the NDX, right? When it's moving 500-600, right? And so, it's they withheld for the day and stuff, and that's cool, but it felt terrible to do that, right? But they work out. So what felt really good to do was sell put spreads, and if I had sold the put spreads I was looking at selling, they would have gotten hit about mid-morning, and so it was just better off doing it that way. And so if this thing starts rallying, though, you better believe I'll be selling put spreads, following it up. I'll do daily put spreads, follow the sucker up, but I want to see it change its character.
Hey, just one thing I want to leave you guys with here is I'm seeing something. This is the advancers minus decliners on the S&P 500. So if you think about this, there's 500 stocks in the S&P 500. When we have right now, there's 460 more declining than advancing.
Everybody and their brother.
So we have basically 40 that are either going flat or slightly advancing or something like that. When this hits negative 490 or worse, that is a long signal. That's another long signal to consider. So keep that in your arsenal. Typically I have to buy some type of stock at that point because everything else gets crushed on the way up. But, something, actually, we're going to go over that on Wednesday. So make sure you join us. In the information below, Dave and I are going to be doing a half-year update semi-annual
Yeah, we're doing our
update.
mid-year update. So this is where we kind of analyze where things are, what's worked, what wasn't, what changes we're going to make as from what we see happening in the back half of the year. We always, have some great, things resources we give you guys and stuff and things like that too to help you. I'm kind of excited about this one. I'm actually doing. Spending some time on how you can use AI to help you in your trading better. So, check that out as well. You should be, if you're not on an email list, you would be getting an email on it and stuff. So jump on our email list. You can do it right from our website, and you'll get all the details about it with the links to join and all that stuff. So, and then we'll have it here on YouTube as well.
Okay. Looking forward to seeing everybody out there. Thanks for joining us today. And, good luck with this market. If you need some help, let us know. We've been through these things before. It's never easy, but it can be done. So Thanks, everybody. You guys have a great Monday, and we'll see you around. Adios.
Bye.